Rather than testing a completely new strategy this week, we're going to return to one which we've already tested and which showed some promise. So in this video, I'm going to use the basic strategy, which we've already tested, and then do some more testing and development work to hopefully come up with a completed tradable strategy. By the end of the video, you'll see how we've developed a mean reversion or reversal strategy to trade dollar Swiss franc, which has an equity curve that looks a little bit like this. I'm going to go into much more detail in this video by walking you through some of my thought processes when developing and analysing a trading strategy. I already completed this development for myself a couple of weeks ago, and I didn't plan on making a video about it, but I thought actually it would be really useful for you guys to show you my notes and the development processes which I went through step by step. We're first going to have a look at the strategy rules, and some of you guys will remember those rules from the previous video. And then I'm going to talk about the strategy testing and the optimizations which I'm going to do and why. Amongst those tests, we look at different exits, and one of those exits which I use allows the strategy to have a win rate of over 89%. But I'm going to explain why, in the end, I don't think it's the best exit option to use for this strategy. So first, let me remind you how this strategy works. Here we can see the trade setup. And we can see we've got a doji, a daily bar. So we are looking at the daily time frame here. And we can see that this bar here, this green bar here, is a doji. It has a body, which the body is the range or the distance between the closing price and the open price. For example, if we look here, we've got the close here and the open here, which is the body. We're not looking at the wicks, we're just looking at the body. So we want to see that the body is less than 10% of the entire range, which includes the wicks of the candle. And we're going to vary this. We're going to test whether that 10% is the best or not. So that's the setup. So number one, find that doji. Number two, we're looking at a filter, and we want to see that yesterday's close is the lowest close over the last 10 bars. That's for long trades. When we look at short trades, we want to see that yesterday's close is the highest close over the last 10 bars. Once we see those conditions, we place buy stop order next day at the high of the doji candle, or sell short at the low of the doji candle. Let's have a look at the example again. So this example here, we found the doji with the body less than 10% of the range. Yesterday's bar, which is this large bar here, the close was the highest close over the last 10 bars. We can quite simply see that. So our conditions have been met. And then once we see that, we place a sell short stop order at the low of this doji candle. So we look at the wick and look at the low, and that's where we get in the trade if the next day the price drops and it gets us into the trade. And of course the opposite is for long trades. So that brings us on to the exits. Number one, we've just got a stop loss, and we're just using a fixed pip stop loss. It might be 80 pips, it might be 160, it might be 200. We're going to test this. We're going to look at what works the best. Number two, we've got a stop and reverse. Now this is rarely going to happen. This is when we don't get stopped out and we don't exit for profit or loss. And let's say that we're long. It means that if we get a setup to go short, then we get out of the long trade and get into the short trade. So we stop and reverse, but that rarely happens with the exits that we're using. Number three, we've got a bailout exit. Sometimes I call this the first profitable close. What that means is once we're in a trade, at the end of each trading day, so we're going to look at around 1700 Eastern Standard Time, we look to see if the trade's in profit. If we're in profit, we just bail out. That means we just exit the trade, take the profit, and exit the trade. If we're not in profit, we leave the trade open. And then if we're still in that trade 24 hours later or the end of the next day, then we look again. If we're in profit, we take the money and we exit. If we're not in profit, it stays open, and so on. Number four, we're going to look at a timed exit. This is going to be our main exit for this strategy. And it's just going to be after X number of days in the trade. It might be 3 days, it might be 9 days, it might be 11 days. We're going to test this. I've shown you the three different variables which I'm most keen to test out and optimize. We're going to look at the size of the body of the doji, the fixed pip stop loss, and then look at that timed exit. And we're also going to include the bailout exit. I could also test that 10-day filter. Remember, we're trading a reversal strategy, so we're buying after we've seen a 10-day closing low or shorting after a 10-day closing high. But I wanted to test and optimize as few variables as possible to try and avoid some overfitting. Later in the video, you'll see that when I'm testing the size of the body of that doji, I actually increase the size of it. And what that does is that actually relaxes the entry criteria, thus giving us more trades. And I did that on purpose because I wanted to introduce more trades to the test. But by decreasing that 10-day filter that we've got, reducing that to maybe a 5-day filter, that would also give us more trades too, and possibly even increase the overall net profit. But I suspect that will lower the quality of trades, or it'll add trades or increase trades, which actually make less profit overall. However, like I said, in this study, I didn't adjust that 10-day filter. I did, however, just want to point that out because it would be a very valid test. The last thing I want to mention before we go and have a look at the strategy development and optimizations is the amount of data which I'm using for the test. For the development of this strategy, and for most of the strategies which I develop, I'm going to use a portion of the data which we call the in-sample data. I have complete price data, and for this test I'm using Oanda Forex data. I have data from January 2008 through to March 2023, so just over 15 years worth of data. But I'm only going to be using 10 years of that 15 years of data to do the initial testing and development. For this test, I've chosen to use from January 2010 to January 2020. Once all the testing and the development is completed, then I can introduce the extra data. So we've got an extra 2 years of data prior to the test data we're using, and 3 years of data after the test data. And that additional data is what we call the out of sample data. Ideally, if the strategy is robust and the market hasn't drastically changed, we should see similar strategy results on that out of sample data compared to the larger in-sample data set. If the results of the strategy are wildly different using the out of sample data, I'll probably just discard the strategy. Anyway, let's have a look at the first test. The first test I want to do is looking at the timed exit, so the X-day exit. I'm going to keep the body of the doji at 10%, or when I say 10%, I mean anything less than 10%, and I'm not going to be using a stop loss. Just want to show you here that the data that we're using, this is the in-sample data period from January 2010 to January 2020. Now, looking at the optimization results, you can see that I've optimized the timed exit from 0 through to 25. Now, 0 isn't 0 days in the trade. 0 is using the bailout exit. Now, realistically, I have some preferences for this strategy, and one of those being the maximum trade duration of about 20 days or 4 weeks. But in this test, I've actually tested up to 25 days, just in case I'm limiting the profit by exiting too early. So looking at the results, we look at the net profit, and straight away, the good thing we can see is that they're all profitable. So 100% of these 26 results are profitable, so that's great. Looking for the highest one, I can see that we look here, exiting after 12 days is the best one, or it gives us the most net profit at 42,000. Now, although that is in the middle of some very stable results, it could be a slight outlier, and I don't always like choosing the best result. But what we can see is that starting from about 8 days, we're almost at 30,000, and then from there, right the way through to 25 days, we don't really drop below 30,000. 16 days is just below 30,000, but from what I can see, anything from sort of 8 days onwards produces relatively stable results of 30,000 or more. Now, just before we move on to the next optimization, I just want to show you the results using the bailout exit and some possible issues I have with it. So I have the bailout exit selected, and let's look at the performance report. Percent profitable is 89.36%, so very accurate. We've got a very large average trade at 407. By the time we've taken out some costs, maybe up to 50, we've still got a massive average trade, so that's great. Looking at the equity curve, that's what the equity curve looks like. It's got a flat period, hasn't it? But it's certainly going up. Looking at the close-to-close equity curve, we can see that it is going up. But I just want to show you one standout trade which we've got on this data period, and that's this trade here. We went long on the 25th of January 2012, and you'll notice that we didn't close in profit, or we didn't hit the stop loss until we exited in profit on the 15th of May 2012. So we were actually in that trade for almost 4 months. And like I said earlier, one of my preferences was not to be in the trade for more than about 20 days. And you can see clearly we were in this trade far too long. So that's just one of the issues that I have using the bailout exit for this strategy. Over the last year or so, I've become quite a fan of selecting multiple inputs for the same strategy. What I mean is, rather than using, let's say, a 12-day exit, why not use an 8-day exit, a 16-day exit, and maybe the bailout exit as well? That's 3 different variations of the same strategy. I'll split my capital into 3 and trade 1/3 position using each of the different exits. Because although I do a lot of testing and development, I can see which input worked best in the past, but I really don't know which one is going to work best moving forward. So by choosing 3, I hope to get an average of the results and therefore diversifying within the same strategy. So just bear this concept in mind as I take you through the rest of the development. We've seen that all the trades have a very large average trade value, and for that reason we can afford to try and relax the entry criteria and actually get more trades to try and make more net profit. So the way that I'm going to do that is I'm going to look at the size of that body of the doji. I don't want to make it too big, as this is a doji strategy. This is a narrow range strategy. And I'm going to test both the body size, so adjusting that body size, and the exit both together. So we're running optimization, optimizing 2 different inputs at the same time. I'm going to go from 5 to 20% on the body size, and then I'm going to test a variation of the exit durations from 6 days to 20 days. We've already seen that generally anything less than an 8-day did sort of drop off profit. I'm going to test a body size as low as 5%, not because I want less trades, because it will give us less trades, but to see if it works just from a robustness point of view. So let me show you the results of the optimization. Here we can see both the inputs. We've got my body size and timed exit. So this is the days in trade. This is the body size. I've tested 4 different body sizes, 5, 10, 15 and 20%. And with the timed exit, I've gone from 6 to 20 days in 2-day steps. Now if I sort by net profit, highest first, we can see that body size, there's a lot of 20s there. There's a 15, 15, 10, 20, 15. And coming down to the least profitable, we can see that they're all of the 5%. And that pretty much correlates to the total number of trades. Obviously, if we're more strict with our entry rules, so the lower the body percentage number, then we're going to have less trades. So it seems that the more trades that we can take, then the higher the net profit. And the good news is the average trade values are all very high. So we haven't got to worry about overcoming trading costs. The nice thing is everything makes money here. If we look at each body size individually, we can see that now we've got all the 20s, all the 15s, and looking at which day exit worked the best, we can see that 51,990 using a 12-day exit for a 20% body. Looking at a 15% body, we can see that what worked best, an 8-day exit worked best for 15. On the 10%, we can see that a 12-day worked best. And on the 5%, we can see 12 worked the best for that as well. So we can see that both exit durations, 8 and 12, both work well, but they all make money. And we can also see that the more money is made with the larger body percentage. And all exit durations work, 8 and 12 being the best on some of them. But just looking at the timed exit again, we can see that with the body percentage of 20, got a 20-day exit, we're making 51,400. 12 days makes 51,990, and 8 days is just a little bit less than that. So in terms of efficiency, we're holding the trade for less than half the time using an 8-day exit to a 20-day exit, and yet we're only dropping a tiny bit of profit. So I am leaning towards using 8 days as our exit. Varying the exit duration only changes how long we're in the same trade for. Sure, if we have an exit of 3 days, then we might have opportunity to enter more trades which came along than if we were holding trades for 20 days. For that reason, I'm going to keep the exit duration fixed, maybe 8 or 10 days, and look at varying the size of the doji body instead. So we'll have a fixed exit duration, and then I'll vary the size of that body probably between 10 and 20%. But remember, the good thing is they all work. Next, we need a stop loss. Once we have that, then we can choose what body percentage inputs to use, and then test it on the complete data set, including that extra 5 years of out of sample data. I'll then be using MultiCharts Portfolio Trader and select 3 different strategies using the 3 different inputs, splitting the position into thirds so that we can see what the results look like both individually for each of the inputs I've chosen, but then collectively as a portfolio together. Just before we do that though, if you like rule-based strategies like the one we're developing here in this video, you might want to get my 22-page Beat the Markets strategy guidebook, in which I'll give you 3 more rule-based strategies which do have pretty decent backtests. You can get that for free at the moment if you find the link down below in the description. Better than that though, you can also enroll in my popular trading course, and amongst other lessons you can get 6 more trading strategies with all the rules and the backtests and instructions exactly how to trade them. And if you're a MultiCharts or a TradeStation user, I even give you the code. So I'll leave the links for that also down in the description. Now, let's have a look at finishing this development. I've decided to stay with an exit duration of 8 days for the next tests, but I'm going to vary the body size or the body percentage between 10 and 20%. I think I'm going to use 11, 14 and 17%. I could have used 10, 15, 20 or 12, 16, 20. It doesn't really matter that much because they all work anyway. Now I'm going to test the fixed pip stop loss for each of those 3 body percentages. So let's first do the test using the 11%. So body size 11% and the timed exit 8 days. We're going to look for the best stop loss, and we're going to go from 0 to 500 pips in steps of 25 pips. Looking for the highest net profit, we can see the highest is 300 pips at 23,000, but 22,175 pips is still a very close number. Anything from 150, certainly 175 onwards is working quite well. Okay, so let's do the next test on the next body percentage. Of course, I could have run these both together. I could have tested both the stop loss and the body percentage together, but I'm just going to show you how we can do it separately as well. So the results for the 14% body, the best is 300. I think 300 pips is the best, but anything from 125 pips, certainly 150 pips onwards, does work very well. So they're all very stable. And let's lastly test the 17% body percentage. The highest being 300 pips again. So 300 pips seems to be the best on a lot of them. But again, anything from 125, certainly 150 pips onwards does work very well, as with the other body percentages too. And I want to keep the stop loss the same across each of the strategies. Obviously I could choose the best one for each of the body percentages, but I don't want to do that. I want to keep them the same. So I think I'm going to choose 150 pips. Quite often, especially with a reversal strategy, using a tighter stop loss like 150 compared to 300 can actually ruin the equity curve compared to using a wider stop loss. But in this case of this strategy, and I have tested this, it doesn't actually ruin the equity curve. So I can keep that much tighter stop loss, which means that we can actually make more money if we're basing our position size on the stop loss value. In effect, with the stop loss, which is half, so we're using 150 pip stop loss compared to a 300 pip stop loss, we can actually double our position size. We do have to take into account the maximum drawdown, etc. of the strategy. But just in general, on this strategy, using that tighter 150 pip stop loss, we can actually make more money than using the wider 300. So now we have three variations of the same strategy. We can vary that body percentage. Let's use 11%, 14%, and 17%. But remember, everything in between also works. Let's fix the exit at 8 days, and let's use a stop loss of 150 pips. We could trade any one of those strategies individually, but like I said, I want to combine them, split my position into thirds, and then trade each one of the variations in a portfolio. So let's have a look at the portfolio trader to see how they all work as a portfolio collectively. Now we're looking at the MultiCharts portfolio trader, where we can combine the three slightly different strategies. And I'll just show you that we've got three different signals here, three different strategies, strategy 1, 2, and 3. So we look at the signals for strategy 1, we can see that we're using body percentage 11, all of them are going to be using the timed exit of 8 and the 150 pip stop loss. Look at number 2, we can see we're using 14% for the body percentage, and 3, we're using 17%. And to keep the numbers fairly similar, instead of testing with one full lot like I was in the previous tests, now I'm only trading 1/3 of a lot for each of the strategies. So when we look at the results for the strategies individually, you'll notice that numbers are only going to be 1/3 of what we've previously seen. But then collectively in a portfolio, when we've got them all three together, then that's going to be kind of like the average of the three. Firstly, let's look at the results combining the three strategies just using the in-sample data. And you can see that we got data from January 2010 to January 2020, just like we've been testing on so far. So let's have a look at the results. Making almost 44,000. That's what the equity curve looks like, which is pretty nice. Close to close equity curve. Total trade analysis shows 197 trades. So we've got 3 lots of the strategies now. So we've got far more trades. Average trade value, even at 1/3, we've still got a very high average trade value. Realistically, to compare to what we've already been doing, we should multiply that by 3. But even so, we're still more than paying for trading costs and making a load of profit on top. Let's have a look at the individual strategies, and these are strategies that you would have already seen. So the first one is using the 11% for the body, 14%, and the 17%, and they're all fairly similar, aren't they? And they all work. So now let's adjust the data and introduce the out of sample data. I'm going to put the 1st January 2024, but I can tell you I've only got data uploaded on here till the middle of March 2023. So let's run the back test. Total net profit, just over 41,000. Equity curve, this is what we're interested in, and it's slightly choppy, slightly uneven on those early years. Remember, we've got from 2008 to 2010, which was our out of sample data, and then we've got about 3 years starting from, if I line up, from about here onwards. So this is our out of sample most recent data, and even though this is a little bit choppy here, I'm not quite as worried about that as if that choppiness was in the most recent years. But I am quite pleased with the equity curve looking at the recent years. That's what the equity curve looks like, close to close. And lastly, let's just have a look at our individual markets using the 11% body There's the equity curve. The 14%, very similar, and 17%, again, very similar. But they're all working. So overall, I am quite pleased with that. What I could do is start adjusting some of the inputs again, adjusting the X day exit and having a look to see what it looks like on the out of sample data. But that's just something I don't do because that is just overfitting. I'm just happy that the inputs that I've chosen without using the out of sample data are working and hopefully will continue to work into the future. That's about all for this longer than usual video. Thanks for staying till the end, and I hope you've enjoyed the video. As I said at the beginning of the video, I didn't actually plan this strategy to be a video, but I thought it'd be useful just documenting some of the development process which I went through. I actually did a load more testing, including a lot of testing with that bailout exit too. I introduced a timed stop loss so that avoids when we're in a trade for a long period of time where the market's just going sideways, where we're not getting stopped out and we're not taking any profit. But I didn't find anything that I was particularly happy with. Results seem much better just exiting after a fixed duration. Anything between about 8 and 20 days seemed to work well. So I've given you a variation of different input options, but the point is they all seem to work. Hopefully that gives us some sort of indication that this strategy will continue to work into the future. After all, that is our ultimate goal. One last thing I will adjust if I decide to take this strategy live is to adjust the exit time of the trade. At the moment, because I've got the testing done on daily bars, if we exit the trade after 10 days, for example, then what that will do is it will exit at the start of the new trading session, which typically is around 1700. And we can have some wide trading spreads then. I'll probably bring that forward 15 minutes, so probably exit the trades 15 minutes before the session ends, around 16:45. And that also goes with the entries. Although we are using stop orders, so we don't know at what time of the day the order's going to be triggered, I might still create a time window, probably from 1700 to 1830, so a 90-minute time window where we don't enter trades to try and avoid those larger spreads. I'll have to test this out because they will change the results very slightly, but I don't suspect it's going to be anything too significant. Anyway, please give me a thumbs up if you've enjoyed this video, and I hope to see you next time. But until then, this is Jared Goodwin, and thank you.